Welcome or welcome back to Retirement Security Simplified, the channel where we cut through the noise and help you build a retirement you can actually count on. Before we get into today's topic, I want to ask you something. When was the last time you took a real, honest look at your retirement plan? Not just your account balance, but the whole picture. The income, the taxes, the healthcare costs, the what ifs. Here's the truth that most people don't hear until it's too late. The questions you ask in the 2 to 5 years before you retire will determine whether your retirement feels like freedom or feels like financial anxiety with a side of regret. Today, I'm going to give you the 15 questions every pre-retiree should be asking right now. By the end of this video, you'll have a clear roadmap of exactly where to focus your attention before you make the leap into retirement. Let's get into it. The very first thing we need to talk about is income, because in retirement, income is everything. When you're working, your employer sends you a paycheck like clockwork. You know what's coming in, and you plan around it. But the moment you retire, that paycheck stops. And now it's on you to create your own. So the first question you need to ask yourself is this: what will my guaranteed monthly income be in retirement? I want you to think about every source of income that will show up no matter what. No matter what the market does, no matter how long you live, no matter what happens in the economy. For most people, that starts with Social Security. Have you actually gone to SSA.gov and looked at your benefit estimate? Not guessed, actually looked. The difference between what people assume they'll receive and what they're actually entitled to can be shocking. If you have a pension, that counts here too. And if you have a pension, make sure you understand your payout options, because once you make that election, you typically cannot change it. The second question is, will my guaranteed income cover my essential expenses? This is where things get real. I want you to write down your non-negotiable monthly expenses: housing, utilities, groceries, transportation, insurance, and healthcare. Then compare that number to your guaranteed income. If your guaranteed income covers your essential expenses, you're in a very strong position. If there's a gap, and for many people there is, that gap needs a plan. It doesn't take care of itself. This concept is called your income floor. Think of it like the foundation of a house. Everything else you build sits on top of it. Without a solid floor, everything above it is at risk. The third question is, when should I claim Social Security? This is one of the most important financial decisions you will make in your entire life. And most people make it without fully understanding the consequences. If you claim Social Security at 62, you're accepting a permanently reduced benefit. We're not talking about a small haircut. Depending on your full retirement age, claiming early could reduce your benefit by 25 to 30% for life. On the other hand, every year you delay past your full retirement age, your benefit grows by 8%, up to age 70. That's a guaranteed 8% growth rate. You'll not find that anywhere else. And if you're married, this decision affects your spouse's survivor benefit too. The higher earner's benefit becomes the survivor benefit when one spouse passes away. That decision lasts a lifetime. Now that we've talked about income, let's talk about your savings, because your nest egg plays a very specific role in retirement, and it may be very different from what you think. Question 4 is, how much do I actually need saved to retire? You've probably heard a number thrown around, $1 million, $2 million, whatever the headline of the week says. But here's the honest answer. It depends. It depends on your income gap. It depends on your lifestyle. It depends on how long you're likely to live. It depends on whether you have a pension. There's no magic number that applies to everyone. What matters is whether your savings, combined with your guaranteed income, can support the lifestyle you want without running out. That's the real question. Question 5. Am I taking too much risk with money I can't afford to lose? I need you to really sit with this one. There's a risk in retirement that most people have never heard of, and it's one of the most dangerous threats to your financial security. It's called sequence of returns risk. Here's what that means in plain English. If you retire and the market drops significantly in your first few years, let's say 25 or 30%, and you're pulling money out of that portfolio to live on, you could permanently damage your retirement. Not temporarily, permanently. Because you're selling shares at low prices to cover your expenses. You have fewer shares to recover when the market comes back, and the math never quite catches up. So ask yourself this: if the market dropped 30% the year you retire, what would you do? Could you stop taking withdrawals? Could you wait 5 years for the market to recover? If the answer is no, and for most retirees it is, then you may be carrying more risk than you realize. Question 6. Do I have a plan for turning my savings into reliable income? This is a shift that most people miss. For your entire working life, the goal was to accumulate, save more, grow more, build the pile. But in retirement, the goal changes completely. Now you need to distribute. Turn that pile into a paycheck that lasts as long as you do. Those are two completely different skill sets, and the strategies that built your wealth may not be the right strategies to protect and distribute it. One tool that some retirees use to create guaranteed lifetime income from their savings is an annuity, specifically a fixed indexed annuity with an income rider. This type of product can turn a portion of your savings into a paycheck you cannot outlive, without putting your principal at risk in the market. It's not right for everyone, but it's worth understanding as part of the conversation. All right, let's talk about taxes, because this is the area where I see pre-retirees get blindsided more than almost anywhere else. Question number 7. Will my Social Security benefits be taxed? Many people assume Social Security is tax-free, and for some people it is. But for many retirees, especially those with other sources of income, up to 85% of their Social Security benefit can be subject to federal income tax. The way the IRS determines this is through something called provisional income. In simple terms, provisional income is your adjusted gross income plus any tax-exempt interest you receive plus half of your Social Security benefit. If that combined number exceeds certain thresholds, and those thresholds have not been adjusted for inflation in decades, a portion of your Social Security becomes taxable. This is not something that happens to wealthy retirees only. It catches middle income retirees every single day. And the good news is, with smart planning, it can often be reduced or managed. Question 8. What will my required minimum distributions look like? And am I prepared for them? If you have money in a traditional IRA, a 401k, a 403b, or most other tax-deferred accounts, the IRS does not let that money sit there forever untaxed. Starting at age 73, they require you to begin taking withdrawals, whether you need the money or not. Those are your required minimum distributions, or RMDs. Here's why this matters. For people who've saved diligently over their career, those RMDs can be significant. And when they stack on top of Social Security and Social Security becomes taxable and it all pushes you into a higher tax bracket, That is what we call the tax torpedo. It hits quietly and it hits hard. Question 9. Should I be doing Roth conversions before I retire? The years between retirement and age 73, when RMDs begin, are often the most valuable tax planning window of your entire life. Your income may be lower than it was during your working years. Your tax bracket may be lower. And if you haven't started taking Social Security yet, your taxable income could be at its lowest point in decades. This window is an opportunity to convert some of your traditional IRA or 401k money into a Roth. Pay taxes now at a lower rate so that money grows tax-free and creates zero RMD obligations in the future. This is not a strategy everyone should use, but it is a conversation worth having with a qualified professional before the window closes. Now, let's talk about two of the biggest risks in retirement that people consistently underestimate: healthcare costs and longevity. Question 10. When and how do I sign up for Medicare, and what will it cost me? If you're turning 65, Medicare is coming, whether you're ready for it or not, and the rules around enrollment are more complicated than most people expect. Miss your enrollment window, and you could face a late enrollment penalty that follows you for the rest of your life. Miss it by 2 years, and that penalty adds up fast. Medicare has multiple parts. Part A covers hospital stays, Part B covers doctor visits and outpatient care. Part D covers prescription drugs. And then there's the private insurance side, Medicare Advantage, which is Part C, or Medigap, which fills in the gaps from Part A and Part B. Here's something many higher earners don't see coming: IRMAA. That stands for Income Related Monthly Adjustment Amount. If your income exceeds certain thresholds based on your tax return from 2 years ago, you will pay more for Medicare than the standard premium. For some retirees, IRMAA surcharges can add hundreds of dollars per month to their Medicare costs. This is absolutely something that can be planned around, but only if you know it's coming. Question 11. What is my plan if I need long-term care? I'm going to share a statistic with you that most people find uncomfortable. The majority of Americans who reach age 65 will need some form of long-term care at some point in their lives. That includes in-home care, assisted living, or a nursing home. And the cost of that care is staggering. Depending on where you live, a private room in a nursing home can run anywhere from $7,000 to $10,000 per month or more. Even in-home care for just a few hours a day adds up quickly. Medicare does not cover long-term custodial care. Medicaid does, but only after you've spent down most of your assets. So the question is, what's your plan? Are you self-insuring, meaning you're planning to pay out of pocket? Have you looked at traditional long-term care insurance? Or have you explored hybrid products, annuities, or life insurance policies that include long-term care benefits? There's no single right answer, but having no answer is the one option that can devastate a retirement plan. Question 12. Am I planning for a 25 or 30-year retirement? Here's something worth celebrating and planning for at the same time. People are living longer than ever. If you retire at 65, there's a very real possibility that you will live into your late 80s or even your 90s. For a couple, the odds that at least one spouse lives past 90 are significant. That means your retirement could last 25 or 30 years. And that means your money needs to last 25 or 30 years too. Longevity is not just a blessing. For people who haven't planned for it, it's a financial risk. Running out of money at 85 is not an abstract possibility. It happens to real people every day. This is exactly why guaranteed lifetime income strategies matter so much in retirement planning. We're almost there. The last category is legacy and planning, making sure the right things happen for the people you love. Question 13. Do I have updated beneficiary designations on all my accounts? This is one of the simplest things you can do and one of the most commonly neglected. Here's something that surprises a lot of people. Your beneficiary designations override your will. It doesn't matter what your will says. Whoever is listed as a beneficiary on your IRA, your 401k, your annuity, and your life insurance, that is who receives the money. Period. I have seen situations where someone updated their will after a divorce but never updated their beneficiary designations. Their ex-spouse received the IRA. The will was irrelevant. Take an hour. Pull out every financial account you own. Check the beneficiary designations. Make sure they reflect your current wishes and your current life. Question 14. Do I have an estate plan in place? At a minimum, a will and a power of attorney. You don't have to be wealthy to need an estate plan. Everyone needs a will. Everyone needs a durable power of attorney, a document that designates someone you trust to make financial decisions on your behalf if you're ever unable to do so yourself. You should consider a healthcare directive, also called a living will, that spells out your medical wishes if you're ever incapacitated. Without these documents, the courts make decisions that should be yours to make. It's one of the most loving things you can do for your family and for yourself. Question 15. Have I worked with a professional who specializes in retirement income planning? This last question might be the most important one on the list. There is a big difference between an advisor who helps people accumulate wealth and an advisor who specializes in retirement income planning. The accumulation phase and the distribution phase require completely different strategies, different tools, and a different mindset. A retirement income specialist understands how Social Security timing, tax planning, Medicare costs, long-term care risk, and guaranteed income strategies all work together as a system, not separate pieces. If you have never had that kind of comprehensive retirement income conversation, now is the time. Let's bring it all together. Today we walk through 15 questions across 5 categories: income, savings, taxes, healthcare, and legacy. These are the questions that separate people who retire with confidence from people who retire and hope for the best. And here's what I want you to take away from this video. Retirement planning is not about picking the right stock or timing the market. It's about building a system where your income is predictable, your taxes are managed, your health care is covered, and your money is designed to last as long as you do. Now, I know some of these questions probably stirred up some thoughts, maybe some concerns about your own situation. That's completely normal, and it's actually a good thing because it means you're paying attention. If you'd like to learn more, take a look at the free booklet called Retire Smart. It's available on the page that's linked in the description box. If you found this video helpful, please give it a thumbs up. It helps this channel reach more people who need this information. And if you're not subscribed yet, hit that subscribe button so you don't miss what's coming next. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.